the smart money actually comes from the one moment. Yeah, it actually comes from the stock market because, as you know, volumes of the stock market are extremely high compared to crypto.
Mm-hmm.
And there is also like some algorithmic trading that moves the price to the desired direction so that like institutional traders, banks, and hedge funds can build their positions in the best price range. So
Yeah. So what are the big differences between the smart money traders and the retail traders? I mean, the banks they have far larger amounts to trade with, of course. So
yeah, exactly. So the smart money or like the institutional traders, like any trader with huge portfolios, they need to have some other traders on the other side to fill their position. So if you're looking to buy in Bitcoin for, I don't know, like $10 billion,
mm-hmm.
you need enough retail traders to sell into this amount of money. So, but you definitely cannot do that in one order. If you just place one market order to buy $10 billion worth of Bitcoin, you'll push the price very high.
yeah.
So yeah, they use some kind of algorithms that allow them to move, like first of all, move the price down, and then partially and slowly fulfill their small positions until they're ready, and then they'll move the price up.
Right.
So yeah, that's the main idea.
And the idea is just to get in where they get in, so we could ride the wave with them when they push
Yeah,
the price up or down, of course.
exactly. Yeah, since they have large amounts, they cannot fill their orders without us noticing it if we know the things to look for. And so, yeah, we can learn this concept and it will help us find clues of the chart in order to move the price and move with the smart money into
So
the correct direction.
so how do they move uh, these markets? Do you have? I think you have an image for that.
This one?
Yeah.
Yeah. So, main thing is liquidity, because if you don't have any liquidity, then you cannot fill your orders. So, they usually move the price into these levels of high liquidity in order to retail traders to sell when smart money wants to buy, and vice versa. They can move the price up where retails will buy and smart money will sell.
Right. So where I previously, so in my trading, I usually set the stop losses under a swing low because I think that the price will move further down if it breaks my support and resistance level. But actually, what you're saying now is that that's, you know, that could very well be a false breakout and the the big people sweeping my liquidity, taking my stop loss, and saying, "Thank you, we're going to push the price higher now."
Yeah, it is possible. Like later, we will learn how to identify the strong swings that are less likely to be breaking out.
Mhm.
But
Yeah,
yeah, the
yeah,
idea is that
because it doesn't
they
happen all the
usually
time. Of course,
hunt.
right? It does, it's not. It's not
Yeah,
always a
exactly.
sweep. It can actually be a push down. So yeah. Okay. So I think we would need to look at some like the market structure.
Yeah. So
I think you've prepared some for that.
one moment. So yeah, here is the basic view of the market structure.
And this is for an uptrend, then I suppose.
Yeah, this is an uptrend. So we have the low point, the high point, higher low, higher high, higher low, higher high. And if you would look at that, you would suggest that, well, it will probably do like this next time. So you would look to buy somewhere here and sell higher.
Hmm.
But that's exactly what the mistake that retail traders do. Like that's the trap of the smart money. So here's an example. You would assume that this swing low is a strong support point. So you would enter your position somewhere here, and entering a long position is a buy order, as we know.
Yeah.
So the stop loss to the long position will be a sell order. So you would enter this position assuming it's going up, but then you would see that a lot of other traders would also place a lot of sell orders below the swing low.
So those are like stop limit orders, right? Or stop market orders.
Yeah, these are stop limit orders. And this creates a lot of liquidity. That's exactly what we discussed before.
Hmm.
So smart money really wants to push the price into this area to force you to sell here, and then they will continue going up. So that's the trick that they do. So every swing low has this liquidity area, a lot of sell orders under every swing low, and also every swing high has its own liquidity, but it's buy orders.
Oh, we're getting someone who says that I always thought the large lots were bought directly from the miners, and they didn't expect this. That's exactly it, right? So you can buy it from the miners directly, or you could buy it from the retailers at a price below the market rate, because you're actually taking the liquidity from the stop loss orders, which is not where the price is currently. So you're moving the market to a favorable position, and then you're just sweeping up all those stop loss orders, getting very large
Yeah,
amounts of volume. And I think, like if I remember correctly from these charts, a lot of the times when you see those big wicks, and sometimes they can be very massive, and it's usually triggered by all these stop losses, right? Because on the exchanges, the way that the stop losses work is that one gets triggered with a market order, they clear the order book, then another one gets cleared, and another one, and another one, and another one, and you get this really big waterfall of orders being put on the order book of liquidity that wasn't there before. It's just like hidden in the order book, and then all of a sudden it becomes available. That's exactly what they are looking for, and
yeah,
that's
yeah, that's correct.
exactly where we want to be when we want to buy, right? Because that's a clear indication of the price being pushed up.
Yeah, so as price gets to this point, and then it stops out the first traders in this area, it's the sell orders from the stop loss. So the sells pushes the price even further down. So it starts selling again, moving down. We hit another sell orders. We move the price even lower. It moves like it triggers another stop losses. So this is how these weeks are happening. And then exactly as these weeks are happening here, as these sell orders are being executed, the large funds, large traders, they buy here and then they move the price. And also this idea is actually very similar to what Wyckoff did like 100 years ago.
Who was
So it was way
who was
way
Wy-
before the mining.
who was
The
Wyckoff?
Richard Wyckoff.
Yeah,
Do you know about it?
I've heard
Yeah,
about him, but maybe people in the stream have not heard about him.
yeah. That's a trader who created a lot of really interesting uh, documents and strategies on trading.
Yeah, so basically he realized that uh, there were some, like, everything is psychology in the market, right? So what Wyckoff realized is that if you make the charts appear in a certain pattern, it's going to create the best amount of psychology for retail traders to get freaked out, right? So you first push the price up in a specific pattern, and then you make them look like you're going to have a small correction and then a big move to the upside, and then they say, nope, we're going to push the price all the way down. And that's what they call that's what they call the Wyckoff distribution. And this is
Yeah.
an insane theory that um, like a couple of years ago we actually saw this pattern in Bitcoin, and as we all know, that pushed the price down all the way to 20,000, 16,000 in the last bear market. So clear manipulation of the market by the big players just to get in at those low levels. And that's exactly what we're seeing here, but on smaller time frames and smaller moves.
Yeah, so basically everything that Wyckoff said, it is very similar to smart money. And smart money is just much more simplified compared to Wyckoff. So yeah, that's why it came way before the mining. And also it is long time adopted in the stock market with algorithms. So it's not just in crypto. And crypto is just now getting some huge volumes coming in. And this is why it is becoming more like the stock market as well. So that's why we are adopting this concept.
Someone is asking, surely to push the price down, they have to sell some Bitcoin first, right?
Yeah, exactly.
That's correct. They do that. But not only do they have to sell some Bitcoin first, they can also, so on larger scales, they even create market sentiment outside of the market. So they would push news items, they would create FOMO, they would create fear, and everything they will do in their power to move the price down cheaply so that they can step in with very large amounts and make it all back on the way up. So their investment is not just the coins that they buy, their investment is the whole thing around it. So the selling of Bitcoin first to push the price down, creating the market fear, creating the news items and everything like that to push the price down, and then they step in.
Yeah, exactly. And also like, yeah, sometimes they sell the Bitcoin, for example, and they also like they create losing position on purpose in order to move the price down. But then when the price gets into the correct price range where they wanted to buy, they will then compensate all those losses. So that's the idea behind it.
Yeah, so someone says, so just like we have seen in the past few weeks. Well, exactly. Like if you look at the Bitcoin market for the past few days or weeks, it's been trading in a pattern that I haven't seen that in a long time, with these crazy daily candles, where the open and close is pretty much the same, and the high and low is like very like 2.5% difference. It's crazy manipulation. Like they're either accumulating Bitcoin to push the price further, or they're slowly selling their Bitcoin to keep the price down, expecting another push to the downward side. So it's always like we don't really know for sure what is going on, but that there is currently some manipulation happening. Yes, you can bet your money on that. Someone's asking if we can explain how to use Altrady to trade this kind of charts. Well, that's gonna come in far later in this series, because at the moment we're going to be learning the steps, the theory behind this smart money concept, and then later on we will actually be doing paper trading and then live trading with real money. But that will be later on in this series. Because first off, we need to understand what are the key concept of the market structures. So we've seen the lower highs, higher highs, and in this case it was the uptrend. You can also have it in a downtrend, of course. But we should probably talk about the liquidity zones. We've already mentioned them briefly, that the liquidity zones were with where the stop loss orders are.
Yeah, so I just want to show you one example with the swings and also the liquidity. So here's a real example of the chart with the swing high, low. So it's definitely going up. And we have swing low here, assuming that it might be a really good support level.
Mm-hmm.
So if you were a trader at this point, you would suggest that price drops somewhere here. You would place your stop loss below the recent swing low and take profit somewhere higher, aiming for, I don't know, at least to this higher high.
Yeah.
So let's see what happened. So you had one wick down that might have stopped some traders, but it didn't go below the swing low. So it's still okay. And then this happened. So you would get stopped out at this point. This means like a lot of sell orders have been executed at this point. And also, let's not forget about the breakout traders. What they usually do when they see this kind of pattern,
Yeah.
they would usually start selling here, right? So that's another sell order up to the stop losses that are being sold. They open another short positions here. So another sell orders that are creating this cascade of orders that are dropping the price down. But if we look further, we will see that price goes up. And these are the stop loss on this short position is a buy order. And so buys push the price up, as well as the buys from the institutional traders. So at this point, you can see that they have swept this liquidity level.
So that's exactly the let me, so this is exactly that type of move, right? Where a lot of stop losses were triggered, creating that special type of what was this again? This was the hammer candle, like where you have a very small open and close box
Yeah.
with a very large wick down. I mean, even further than this. Like this is a crazy one.
Yeah. And we can see what happens after that.
Someone asks, how can you recognize this in the order book? Well,
It's really hard
yeah,
to do that.
yeah, it's because the orders are hidden, right? The stop orders are not actually in the order book until the stop price is triggered. So the smart money concept is basically just looking at the price action in the charts. So you're not actually looking at the order book itself. Yeah. Okay, continue.
Yeah. Yeah. So you cannot see that in the order book, but if you look closely on the chart, you will see these clues and you'll be able to follow the smart money. So let's say if we would look at the smaller time frame here, we would notice this is a really nice smart money reversal pattern. And if you were there, you would be able to open this position.
Right. So in this case, you would open it, like as soon as it breaks this high, this lower high, breaks it and then retests it. Is that
Yeah.
correct? Yeah.
Yeah, this is like the most basic smart money reversal, but like the setup. So as soon as you have this shift in market structure like this, then it suggests you that the market is ready to remove. Not remove, reverse.
Someone asks if you can see the volume. Like,
Well, in smart money, you can use volume as like extra confirmation, but it's not really being used as some kind of indicator. Just like when you see the volume is going down, that you usually use volume when the price is consolidating in ranges, and then it helps you really understand where you are in the market. But yeah, it's just like extra confirmations. It's not the indicator to use for trading. And also the same like the RSI as well. You can use RSI as extra confirmation when you see the possible reversal on the chart, suggesting it's going up. Then you can look at the volume, seeing that the volume is increasing. It's another point into reversal, and then you can find the divergence on the RSI. So that's the third confirmation, and you can make much better decision with that.
Yeah. Yeah. Okay.
Yeah, let's look at this position.
Oh wow. That's I mean 6.5, right? So this is also something really important to understand, right? Okay, so this is a 49% growth, right? But think of it like in terms of risk reward ratio. So 6.5 risk reward ratio, depending on how much risk you take on your portfolio. If you trade with 1% of your portfolio, this move would mean that you gain 6.5% on your total portfolio. That's a massive move. That's a massive move. And if you trade with 5%,
Yeah,
then this would be a 30% increase of your total portfolio. And I mean, the reason why I got really intrigued by this trading strategy that you've been nagging me about really is that you showed me that you increased your futures portfolio quite significantly in a very short amount of time. What you gained like 40% in 1 month?
yeah, I had 1 month with 70%.
70, Jesus.
Then yeah,
Yeah.
but yeah, it's for me, it's not consistent yet, so that's why I choose the learning path.
Yeah, no, of course, of course. That's so. Again, to reiterate, we're no experts. We're learning this as we go along, and we're telling you what we've learned in the past few weeks. By no means are we experts. By no means do we say risk your money, follow this strategy, and you'll become rich, just like Wyckoff, I suppose. But yeah, it's still like impressive to get 70% growth on your portfolio, right, in 1 month.
Yeah, so as you can see, this was just the sweep of this liquidity level that we had here. And as soon as that happened, the price just reversed, looking for the next level of liquidity. So at this point, we had sell side liquidity line here. So a lot of short positions have been opened somewhere here with stop losses around the swing high. And yeah, price just went there and took out these short traders. So the key rule of this smart money concept is that price moves from liquidity to liquidity.
Right.
It takes liquidity from the long traders, then it goes and takes out liquidity from short traders. It goes up and down between key liquidity levels.
Someone mentions ICT. Yes, correct.
Yeah. I mean, ICT is a very controversial person, but
Well,
the things that he shared,
his controversy comes mostly from the way that he shares his successes, right? So
yeah.
that for people who don't know ICT, he's a famous trader and also notoriously famous for yeah, I'm not sure like if it's is it faking his results or just photoshopping his results was things like that, but the idea is the same. And if we know for a fact that this trading strategy is profitable and very successful, also because the course that you're following, Roman, you're following that from some big time traders who share their results and share their trade setups as they are happening, right? So they can't fake it. They can't say, oh, look at me, I took this trade 3 weeks ago, made 50% profit on that. No, they say, I'm going to enter now, and when their take profit is filled, they say, "So that was a good trade, right?" That's what they do, right?
Yeah. So I've been following these guys that I bought the courses from for over a year because I didn't want to get scammed. So I was following them and I saw that they have really consistent results and they did not fake it.
Yeah. So
But yeah,
so so
like
we're not looking at ICT, but we're looking at the traders that you're following and that you're taking the course from, and yeah, what we're trying to interpret here ourselves. Someone asks, how do you differentiate if it was a false breakout or a real breakout? Would you continue
yeah,
to do DCA all the way down, or
yeah.
not?
Let's go back here. So the whole thing is that you're not looking to buy as soon as this level is breaking down. You're not looking to buy here. You don't need that. You don't want to rush. You don't know like if this level will hold. Maybe it will go further to this level, or maybe it will go to this level. We don't know where the price will stop. But when you see this
Right.
uh,
Right. So
liquidity
just the entry order is not in the liquidity zone itself.
yes, you cannot place your orders beforehand. That's not how smart money works. You don't just look at the zone and place the order because like there were plenty examples of the different swing points where you could place your long positions, but that's not correct. But as soon as price comes into this level, what you want to do is that currently we're on the daily time frame. So now you want to switch to lower time frame, let's say 1 hour time frame. And on the 1 hour time frame, you're looking for this formation. So this would be our liquidity line. Where's that? I have my drawing tools. So you'll be looking for something like this. So price is going down, taking out liquidity. Then you see this break of structure or a shift in market structure on lower time frame. And only when you see this shift, only then you can enter.
Right. So you enter. So you see the sweep happening here. The price moves all the way up, and then you could place your limit order around the break of structure, or are there other things to be looking for to enter or to determine your entry point? Like, do we enter exactly here, or can we enter here, or here, or here, or here?
Well, this is the most basic entry zone. So you can enter here and be safe. We will look into more details later. There are some cases where you can enter lower, or some cases where you would need to enter with market order as soon as you have a candle close about this. But yeah, this is the most simple and conservative way to trade. And yeah, this doesn't stop. Like price can always do this after the sweep. We are not secured from that.
So would you
But
DCA, or would you just use the stop loss that you've configured?
well, usually no, you do not DCA because usually this strategy, like mostly it's used on futures. You can use it on spot as well, but usually it is for futures. And with stop loss, you will be able to collect some nice statistics for you and see your win rate. But yeah, like I mean, on spot you can try DCA, but usually they do that on futures, and on futures you never DCA. Like you use your stop losses. So as soon as price goes down from here, you might see the reversal happening here. So you might want to enter here again. And this time it might be successful.
Right.
So sometimes these oversweeps are happening. So we had one sweep of this main swing point, then we had another swing point that got swept again. But yeah, The
So
third one is very rare. So
so if I understand correctly, this is very much a risk-based style trading where you, you really have to be careful about your success rate and the setups that you take, that they have a high enough risk reward ratio to cover the losses, and especially if you're on a losing streak, that you make enough back on the winning streak to be able to be profitable in the long run, right? But there will be losses. Like this is not guaranteed that every position will be good. I believe you said
yeah,
something like 60 or 50, 60 to 70% success rate. What was it? If you
it
execute it really
depends.
well.
But from the traders that I talk to, they usually have win rate around 50%, sometimes maybe even 45.
Mm-hmm.
But their risk to reward ratio usually minimum 1 to 3. So meaning when they lose, I don't know, like let's say, so you would have 100 trades where 55 of them were winning and 45 winning, 55 lost. And so with 1 to 3 risk to reward ratio, if your position, I don't know, if your risk per position was $100, so on the win, how much you would make? 45 multiplied by 3 is bit like that. Moment. So yeah, you would make this and you would lose this amount. And you can see the difference.
Yeah, that's so. Someone says I read that at 3-to-1 ratio, you only need to be right 30% of the time to be profitable. Well, actually, you need to be right 30% to be break even. So you need to be a little bit better at it. But I mean, a 40% success rate. That's like that. You're still wrong most of the times, but in the end, you're still profitable. That's great, right? So you're you're to be wrong most of the times and still make money. That can only happen in trading, right? If you run a business and you're wrong all the time, then forget about it. Your business is going to go under. But but if you're trading like this, risk reward ratio 3-to-1, 40% win rate, you're there, golden.
Yeah, and actually, to be fair, this 1 to 3 risk to reward ratio is very conservative. I know a lot of traders that usually take at least 1 to 5 or even higher, and still they able to get like 40% win rate.
Yeah.
So
Well,
their gains even higher.
I mean, especially if you're using a tool like Altrady, right, where you have the multiple take profit option plus the trailing take profit and the stop loss move into break even following the take profits. Those types of features can actually help you to increase your risk reward ratio from the initial setup to a far higher risk reward ratio by letting the profits ride. Like a lot of the times it's a great way, like you sell to make sure that your position is profitable and will remain profitable, especially if you put the stop loss protection on, your position will remain profitable, increasing your success rate, but then using the extra take profits and the trailing take profits to maximize everything out of this position. That is how the big traders make the most money, by letting their trades ride.
Yeah, that's true. So yeah, next I wanted to talk about the points of interest.
Yeah.
So you do not only enter at the liquidity sweeps, as we've seen before, there are also so-called points of interest. or points, like zones on the chart where you are looking for the possible reversal. So first, we're starting with the fair value gap, or FVG. This is basically just this distance between two candles. So you can see here. So the high of the one candle and then the low of the third candle is creating a gap between them. This is called fair value gap. And the same for the bearish scenario here. And so the idea is that when price gets into this area, it is expected to provide some reaction in form of reversal. It doesn't work all the time. So again, you don't need to place your entry orders on every fair value gap. But this is where you need to observe the price and look for the reversal patterns.
So just to be absolutely clear on what the fair value gap is, it's the 3 candle pattern where you take the high of the first candle and the low of the last candle, and if there's a gap in between, so if they don't overlap, then that's what we call the fair value gap. And in the bearish one, it's the low of the first and the high of the last to create the fair value gap. It's a very popular
exactly.
term, right? If you search on YouTube for fair value gaps, you'll get bombarded with shorts and videos about how I make 10K a month trading fair value gaps. I mean, okay, great, but it's like they just lure you in and they show you, oh, okay, so this is the replay function, this is how we've traded it, and you would have made X amount of money if you spend, like, if you trade with 50,000, you can earn 10K on a position. Yeah, possible, but how? Like, and first of all, how do I get to 50K? Like, those types of videos and shorts, they always I find them very annoying because they don't actually teach me anything. Like this, like how do I know what a fair value gap is? How do I know when to actually enter and how to spot these things myself? Like, that's what I want to know. That's why we're here.
Yeah. So the idea of the point of interest, so it's the same with the swings as well. So as we had the swing low here, it is also a point of interest because as soon as price hits it, you can look for the reversal. And so the same with the fair value gap. As soon as price gets into this area, you need to switch to the lower time frame. Like assuming this one is daily, you would need to switch to 1 hour. And you would look for this pattern that we discussed before. So this is the basic smart money reversal, where we have this liquidity sweep. Then the structure is breaking here, and then you would enter your position somewhere here.
Right.
So yeah, you always, in smart money, you always need to combine different time frames. You have your main time frame that is higher, for example, like daily or 4 hours. And then you always have your lower time frame where you're looking for these entry models. So for daily, if you're using daily as your main time frame or high time frame, daily, then low time frame would be 1 hour. If your high time frame is 4 hours, then your low time frame is 15 minutes or sometimes 5 minutes. So you always need to look for these combinations, but you cannot use high time frame daily and low time frame 5 minute. They just don't stack.
Okay.
You will get a lot of false signals this way.
Yeah. Wow. Okay. That's good to know.
So yeah, fair value gap is one of the points of interest, and liquidity is another one. So these are two the most popular ones, and
And the
also they
liquidity is
are
just the low point, right? Or the high points. Like,
yeah, but I mean this is so-called external liquidity because it is outside of this trading range.
mm-hmm.
But you can also get a lot of internal liquidity. So if we'd say this is our chart, like this would be liquidity level as well, internal liquidity, this would be internal liquidity. So yeah, there is a lot of liquidity, but
But the external ones are the point of interest.
no, these internal
Are the
liquidity,
internal ones as well? Okay.
yeah. So for example, you you could spot something like this, the sweep of this liquidity, and then break of structure, and yeah, like that. So all liquidity is points of interest,
Right.
but
So,
higher,
so the way
like
to look for the
high,
entries is always looking for a sweep, break of structure, and a retest of the previous lower high.
yeah,
Right. Okay. That
okay,
seems that
yeah.
seems
So
fairly simple.
yeah,
Should I risk my
so
money yet?
this, yeah, you can try right
Can I
now,
can I go 10x leverage, 100x leverage?
100, yeah, right now. So yeah, these like the fair value gap and the liquidity, these are the easiest ones, and they also usually like the best ones, to be honest, because they are pretty easy to spot on the chart, and they usually work really well. So the next one we'll discuss is the order block.
Oh yeah.
So order block is usually the last bearish candle before the price going up, or the last bullish candle before going down. But there are a lot of different techniques on how to properly identify order blocks. Some people don't use wicks, so they use it like this, for example. Some people look for order blocks that create fair value gap.
Yeah, this is. I
And
mean, I've seen a lot of people that, especially people that are trading price action, like smart money concept or other types of price action trading. They always draw these boxes. I'm like, how? Like, what are your criteria? Like, where do you decide to draw this box? Like, especially if you're looking at a candle, you're not looking at anything else. You're not looking at volume. You're not looking at indicators. You're just purely looking at a candle, and you decide, okay, this is where I'm going to draw my box. Like, it always seems magic to me. Is
Mhm.
there a golden rule for it, or is it just something that we need to train along the way?
yeah, you just need to train, but you also need to understand the logic behind the order blocks and how they are formed. So the idea is that inside like this small candle that we have here, if you look on the smaller time frame, you would usually see a lot of like this motion.
Hmm.
This means there were a lot of trading happening in this area, a lot of sells and a lot of buys executed here.
Well, that looks like
And
the Bitcoin daily chart at the moment.
yeah, that's true. And so this is usually the place where the smart money, these big traders with large amounts of money, they uh, accumulate their positions. And so that's why this level is being used like support zone. So since smart money accumulated money in this area, we assume that price will go up. Then if it goes back here, then it will go up again because it was the point of interest where smart money got a lot of assets purchased.
Julian makes an interesting comment saying using just the body means that the narrower the supply or demand area, the more likely the price to retest and reverse. So if it's a small bodied candle, then the support and the support is higher. That's the statement.
Yeah, I
Anyway,
cannot
it
I
doesn't.
cannot comment on that. Yeah.
Yeah. Okay.
I don't have much expertise on order blocks. I just know that they are like very creative, and every trader draws them differently, and you just need to try and see what works for you.
Yeah.
That's what I learned. And yeah, I didn't really try to trade order blocks yet because to me, fair value gap and liquidity are just much easier to understand.
Yeah, I find them like super easy to spot, and yeah, they just have a clear clear set of criteria. Like this is how you draw a fair value gap. Like you can argue whether it's a good one or a bad one, which is something that you need to learn along the way. But how to draw them exactly, that's fairly simple. Actually, so simple that you could create an indicator for it, right? To just have the fair value gaps inside the chart automatically, which is
Yeah, yeah.
which is what we might be adding soon. So fingers crossed.
I'm looking for it.
You just need to tell the
So yeah.
developer to hurry up. Oh wait.
So yeah, similar to the fair value gap, order blocks as points of interest is the place where you would expect the price to come down, and then on lower time frame, you want to see the reversal and hope that price goes up. So yeah, that's the general idea of the points of interest, is that sometimes here you can see the reversal. And let's say at this point you would have a fair value gap, but price didn't react at it at all. Price just went down. But then on the next point of interest, the order block, you would see this reversal and you would try to enter the position.
Yeah.
So yeah, here I have another.
Smart money in a nutshell. Now there you come. You could have told us this from the beginning, right?
Yeah.
I like the nutshell. Okay, go.
So yeah, the whole idea of the smart money is that you just, yeah, first of all, you identify the structure, your high time frame structure. We will learn it on the next stream. Then you identify your points of interest, such as liquidity sweep, fair value gap, order blocks, or breaker blocks. We'll also discuss this later. And then you just wait until the price comes into the zone. So you must just place an alert here. It's not available on replay. So you just place an alert here, and as soon as alert goes, you just open the small time frame, wait for this reversal, and you're ready to enter the position. That's it. That's the smart money. But as simple as it seems, there's a lot of things that you need to learn to really understand the logic. So yeah,
I mean, yeah. Well, in the next streams, we're also going to be, um, they're not all going to be as dry and technical as this one. We're also going to be doing even more tedious stuff, and that's setting the replay, and we'll be doing some exercises on how to draw everything. So we're going to be drawing the highs and lows. We're going to be drawing the fair value gaps. We're going to be drawing the order blocks for as long as we can, because you know, like I think Roman, you have a chart of where you've done that, like one of your replay charts, right?
yeah. So we can see an example like right here. So we had the chart, and what we can see here is the gap between the candles. So this is
Clear
the fair
variable,
value
yeah.
gap. And what happens when price gets into it? You just switch to the lower time frame. So this is it. We wait for the price to get into this zone. And then we're looking for the reversal. And yeah, this is it. So here we can say this is the reversal. This pattern. And you would be able to just open a position from here. Hoping it goes, I don't know, at least here maybe to this fair value gap area, or even lower to this liquidity zone. So you just identified your points of interest. Once
Switch to the
price
lower
got
time
there,
frame. So you set the alert.
yeah,
So your alert would have been somewhere around here, where it triggered the
yeah,
alert. You switch to the lower time frames. You wait for it to happen again. So maybe you set another alert.
yeah. Usually, like you wait until price goes up. So let's go back. So if we were at this point of the chart, I would place my alert here because this would be the point where
Yeah. So this would
the
be where the break would be, and then you're looking for your short entry at this level.
yeah, exactly.
Yeah.
But
So
then
so
I
first
would
alert
see that
here, then alert here, and then entry here. But price
yeah,
moves up, so that's exactly why we didn't
price
put our entry here.
yeah, price moves up, then we place another alert here and wait until the alert goes on. So as soon as the candle closes above this level, we can assume that the reversal is happening and we can place our short position here and wait like this. And as you see, this is we were looking at the daily time frame, and 1 hour was our low time frame. But the beauty of it is that you can use your 1 hour as the high time frame, and then use like 5 minutes as your low time frame. So you can, instead of waiting, what was that, like 22 hours until opening the position, it could be like 2 hours, maybe even 1 hour.
Yeah, it
So
also
that's the
depends
beauty of
on
it, is that
what you're comfortable with, right? If you're comfortable with trading those lower time frames where everything is a little bit more scary, things moving quite fast, or if you're like me, you like it a little bit more relaxed and you trade on the higher time frames.
yeah, so the very popular combination is using your 4 hour time frame as the high time frame, and 15 minutes is your low time frame where you look for confirmation. Um, this works really well on crypto. So for example, if you would trade on Forex, you would probably use 1 hour and 5 minutes, or 1 hour and 3 minutes, maybe. Some use 1 minute as well, but this is too much stress to me.
Yeah, for me as well. Like, and then emotion comes into play, and you're like, yeah, making silly mistakes
Yeah,
that shouldn't.
yeah. Wait, when you use 15 minutes as your low time frame, then you have at least a couple of hours until the position is executed. So you can just leave it and, I don't know, like go walk on the street or somewhere else. And when your position takes like 10 minutes, then you would sit there and wait and stress about it.
Yeah, yeah. But
And yeah, and also,
what I like about this is that the percentages on the low time frames are smaller, but the risk reward ratio it can still be massive, right? So your stop loss is
well,
also a lot shorter. So on the futures exchanges, you could still make the same risk reward ratio on a small time frame. So you could still increase your portfolio by, 5-6% on a trade in a matter of
yeah,
a day or two.
exactly. Yeah, it's all about the risk management and then what risk to reward ratio you're using.
Yeah.
And what I want to say is that usually the higher time frame you use, the better, like the higher probability of these setups are actually executing well, successfully.
Yeah. Well, that makes
Because
sense, of
if you,
course, because the whole thing is that this is smart money by looking at large amounts of volume, and on higher time frames there's a lot more volume than there would be on the lower time frames, right? So if you have a large amount, then you're going to be trading on a daily and a 1 hour chart instead of a 4 hour and 15 or 5 minute chart.
yeah, yeah. And usually, like, I know some traders that just look at the weekly chart and they spot these points of interest on a weekly chart, then their lower time frame is daily or 4 hours, and they just open a position and they can wait like 1 month or like 2 months waiting for it to execute. But they are pretty confident that it will be successful because with this high time frame, it usually works really well.
Nice. Okay, so you've been showing us for almost over an hour. What will we do next? What can people expect if they? So if people, there's still some people left, people that are watching it back later. What can they expect from the next episode, and why should they be there? Why should I be at the next episode? What are we going to learn?
Okay, yes. So the next thing that we will discuss would be how to properly identify these swing points. Because as I learned, not every swing point is the proper key structural swing point. Because before that, I really like, I would, for example, mark this one as a swing point, but this is not a swing point. Or this one, this is not a structural swing point. So on the next stream, we will learn how to properly identify them. And from that, we will learn how to identify the structure, if we are bullish or bearish, and how to not miss that. Because knowing the direction that the smart money is moving the market is the key to success. You can easily spot these points of interest in the wrong direction and find reversal. But if you're trading the wrong direction, you will be stopped out.
Okay, so that's good to know. Then we'll be getting ourselves familiar with the drawing of the higher highs and the higher lows, and knowing exactly when a higher high is a higher high and not part of some kind of internal debate of price. So the question is, when is the next session? Next week, same time, same place. Be there. You'll get the invite again. You should subscribe to the channel, of course, because hey, we're here. Might as well click that button. Doesn't cost anything. And we will be doing this for as long as it takes for me to be profitable. So maybe years, something like that. But
Okay. Yeah, I have like 10 years.
we'll be here for a while. And I hope that you'll be here with us. Yeah, and again, if you've enjoyed this video, please leave a like. It really does help to support our channel and make sure that we can continue to push out this great content. And yeah, then I thank you all for watching, and I hope you will be there on the next live stream. The next live stream will be on Thursday at 3 o'clock UTC time, and that will be with me and Kata. And we have something nice prepared for you again. But for the Smart Money Concept, will be next week on Tuesday, 1 o'clock UTC. Thank you all for watching. Thank you, Roman, for explaining this and preparing all these charts. They look amazing. And
Yep. Thank you too.
I
Thank
have
you, everyone.
high expectations for the next one. So please make sure that you're there.